Welcome back to the deep dive. We're here again to cut through the noise, take all that corporate news, the earnings reports, the strategy docs.
And boil it all down for you. Make sense of it.
Precisely. Today, we're climbing into the cockpit, metaphorically speaking, of a real giant. Honeywell International. Ticker HON.
Yeah, one of the biggest, most complex industrial conglomerates out there. And maybe one that doesn't always get the valuation spotlight it thinks it deserves. Software industrial, they call themselves now.
That's right. And when you look at Honeywell, I mean, this is a company doing roughly $38.5 billion in sales for 2024. They're not just tinkering around the edges.
No, not at all. This is major surgery. We're calling it the Great Realignment. It's like they're tearing down the old conglomerate structure we've known for ages.
And building something new, moving away from that sprawling, a bit of everything model.
Exactly. And the core goal, the big strategic push behind all this, it's about tackling the conglomerate discount.
Ah, yes, the dreaded conglomerate discount. Explain that a bit for us. Why does the market undervalue these big diversified companies sometimes?
Well, it's really about complexity and maybe focus. The market often struggles to value a company accurately when it has wildly different businesses under one roof. Think, high-tech aerospace competing for capital with, say, industrial sensors.
It gets messy, hard to model.
Very. Analysts find it tough. How do you a single multiple on a company that has some parts growing like crazy with huge moats and other parts that are more cyclical, maybe lower margin?
So the market just kind of throws up its hands and applies a discount. Like, it's too complicated, let's just value it lower just in case.
That's basically it. It's a hedge against that uncertainty and complexity. Investors often prefer pure-play companies where they know exactly what they're getting.
And Honeywell's management is saying, enough of that. We'll break it up ourselves to show you the true value. Following the playbook of companies like GE, maybe Danaher.
That's the idea. Force the market to see the value of the individual pieces, especially the really strong ones, by setting them free.
Okay, so this isn't just random chopping. You mentioned it's anchored to some big ideas, 3 secular megatrends.
That's right. They're not just breaking up, they're consciously aligning the future businesses with what they see as the biggest growth waves coming.
What are they?
First, automation. This is huge, covers everything from factory automation, process controls in big industrial plants, all the way to smart buildings.
Makes sense. Everything's getting automated.
Second, the future of aviation. This is just more planes. It's defense, it's space, commercial aerospace, yes, but critically, it includes the massive shift toward sustainable aviation fuels, SAF.
Okay, SAF is definitely a big theme. And the third?
The energy transition. This ties into SAF, but is broader. Think technologies for carbon capture, green hydrogen production, renewable fuel licensing, massive investment needed globally here.
Got it. Automation, future of aviation, energy transition. Those are the guideposts for this. Deconstruction.
Deconstruction, realignment, yeah.
So our mission for you today is pretty clear. We need to really unpack the why behind this. Dig into the performance of the different Honeywell parts before the split.
See which bits were flying high and which were maybe dragging things down.
Exactly. And then figure out what value this whole complex maneuver is actually supposed to unlock for shareholders in these new focused companies. Plus, we have to touch on the huge amount of money they're spending on acquisitions at the same time.
It's a lot to juggle. Let's get into it. All right, to really get why this breakup felt necessary to management, you've got to look at how the different parts were performing. The Q3 2025 numbers, just before some of these big moves were finalized, really paint the picture.
Shows the cracks, maybe? Or the divergence.
Divergence is the perfect word. Huge differences in growth, profitability, even how cyclical these businesses are. It makes that single conglomerate structure really awkward, financially speaking.
They had 4 segments back then, right? But yeah, looking inside, they were very different beasts. Let's start with a star performer, Aerospace Technologies, AT.
Oh yeah, AT was, and arguably still is, the crown jewel. It was the biggest segment by sales, pulling in about $4.5 billion in Q3 25.
Impressive size, but the growth.
That's the kicker. 12% organic growth, 12%. Sure. For a business that size, that's phenomenal. And remember, organic means without counting acquisitions. Real underlying growth.
And profitable.
Extremely. Segment margin was 26.1%, so high growth, high margin, large scale. It was basically carrying a lot of the weight.
What gives aerospace such power? What's the moat there?
It's all about the installed base. Think about it. Honeywell estimates something like 90% of aircraft globally use some piece of their avionics. They've shipped over 100,000 APUs, those auxiliary power units.
So once their equipment is on a plane,
it's incredibly sticky. The cost and, crucially, the regulatory hurdles involved in swapping out core flight systems are just astronomical. FAA, EA certifications. It's a nightmare for an airline to switch.
So they're locked in for the life of the aircraft, pretty much, generating aftermarket revenue.
Exactly. High margin aftermarket revenue.
Mm.
Parts, repairs, services. It's a gift that keeps on giving, especially with global flight hours recovering strongly post-pandemic and defense spending staying high. That 12% growth wasn't a fluke. It was tapping into real tailwinds.
Okay, so AT is the powerhouse. What about building automation, BA? You called it sustainable earlier.
Yeah. BA is the steady Eddie, maybe. Really solid, consistent performer. They do the tech that makes buildings smarter, safer, greener building management systems, BMS, fire, security, plus their software platform, Honeywell Forge.
And the numbers in Q3 25.
Pretty good. $1.9 billion in sales, solid 7% organic growth. And here's the impressive part. The highest segment margin in the whole company at 26.7%.
Higher than aerospace even.
Just slightly, yeah. And they actually expanded that margin by 80 basis points compared to the year before.
80 basis points. So almost a full percentage point improvement in profitability. That's tough to do, especially with inflation being what it was. How'd they manage that?
Strong market tailwinds, really. The push for energy efficiency in buildings is huge, driven by regulations and cost savings, decarbonization efforts. And then there's massive demand from specific sectors like data centers.
Data centers. Huge energy hogs, right? Need sophisticated climate control and management.
Exactly. And BA provides those critical systems. The market for building efficiency tech is growing at double-digit rates, so BA is riding that wave.
Okay, so AT and BA look pretty healthy. Now, let's turn to the segment that seems to be the main reason for this whole realignment, industrial automation, IA.
Yeah, IA is where you saw the strain. This segment includes things like process control systems for big plants, DCS, SCADA plus sensors, and also warehouse automation stuff like mobile computers, barcode scanners.
And the Q3 25 numbers here?
Not great. Only 1% organic growth, flat. And the margins, lowest in the company at 18.8%.
Ouch. And you mentioned contraction.
Yeah, that 18.8% margin was down 150 basis points from the year before.
Wow, 1.5 percentage points wiped off the margin? That's serious. What was going on there? Inflation just eating them alive.
That was a big part of it, yes. Cost inflation was hitting hard, and apparently they couldn't pass it all through or find enough productivity gains to offset it in this segment. It's a huge warning sign when margins contract that much.
But it wasn't just inflation, was it? You hinted that within IA, there were specific problem areas driving the strategic rethink.
Exactly. IA itself is a mix. The core process control business, while cyclical, is fundamentally solid tech. The real issue, the drag, came from the logistics and warehouse automation subsegments.
What are they called again?
PSS Productivity Solutions and Services and WWS Warehouse and Workflow Solutions. These are the bits making the handheld scanners, the mobile computers for warehouses, setting up basic warehouse systems.
And why were they such a bad fit strategically? Low margin, you said.
Yes, low margin, but also just fundamentally different businesses. Think transactional hardware sales, lots of competition, lower barriers to entry compared to, say, aerospace avionics.
Customers can switch suppliers more easily.
Much more easily. Demand is very cyclical. When e-commerce booms, they do well. When it slows, orders dry up fast. It's lumpy, as management described it, very project-based, sensitive to commodity costs.
So the opposite of the sticky, high-margin, long-cycle aerospace business.
Completely. And when you have these lumpy, lower-margin businesses mixed in, they drag down the overall valuation and make the whole company's performance harder to predict. Their struggles really force management's hand to say, okay, maybe these don't belong here anymore. That led straight to the strategic review.
Got it. Okay, one more segment. Energy and Sustainability Solutions, ESS. This is the future tech play, right?
Yeah, ESS is where a lot of the excitement around the energy transition lives. It includes UOP, which is their legacy but very important process technology licensing business for refining and petrochemicals.
Licensing tech, so intellectual property.
Exactly. Plus the newer stuff.
Yeah.
Advanced materials and sustainable technologies like sustainable aviation fuel, SAF, carbon capture tech, hydrogen solutions.
How did ESS do in Q3 25?
Sales were $1.7 billion, but actually down 2% organically. Margin was flat at 24.5%.
Down 2%. Why if it's tied to the energy transition?
It was mostly timing. The UOP licensing business involves huge, multi-million-dollar projects. When those big deals land, can be lumpy year to year. So a slight dip doesn't necessarily mean the long-term trend is broken.
Okay, so maybe some short-term noise, but the strategic importance is clear. It's their main lever for that energy transition megatrend.
Absolutely. So you look at those four segments. You've got aerospace roaring ahead at 12% growth, 26% margin. Building automation solid at 7% growth, nearly 27% margin. Then industrial automation limping at 1% growth, under 19% margin and shrinking.
Yeah, the contrast is stark.
It really is. And that divergence makes it almost impossible for the market to put a fair, consistent value on the whole thing. Hence the need to break it apart.
Okay, so the problem identified. The conglomerate structure is hiding value and creating drag. The solution, the great realignment. This sounds like a massive undertaking.
It is. Radical, aggressive, fast-paced. It's centered around a three-part strategy to create these focused, pure-play companies.
Let's break down those three parts. What's the main event?
The centerpiece, the biggest move, is definitely the aerospace separation. Honeywell announced early in 2025 their plan to spin off the entire aerospace technologies segment.
Set it free as its own company.
Exactly. A standalone, publicly traded company. They're targeting completion for the second half of 2026.
And crucially, how are they doing this? For shareholders, I mean.
This is key. It's structured as a tax-free distribution. Existing Honeywell shareholders will simply receive shares in the new aerospace company without triggering an immediate tax bill.
That's vital, isn't it? A taxable spinoff would kill a lot of the value up front.
Absolutely essential. Doing it tax-free allows that high-performing aerospace business to hopefully achieve that premium valuation like its peers, say GE Aerospace, without shareholders taking an immediate tax hit. Preserves the value unlock.
Okay, so aerospace spinoff is part one. What's part two? You mentioned something already happened.
Yeah, they moved fast on this one. Part two was the spin-off of their Solstice Advanced Materials business. This is stuff like next-gen refrigerants that actually completed ahead of schedule on October 30th, 2025.
So they've already proven they can execute a spinoff relatively quickly.
Right. And that deal resulted in a nice chunk of cash, a $1.5 billion dividend being paid back to the parent Honeywell International. Kind of a down payment on the whole strategy.
Oh, okay. And part three. What happens to everything that's not aerospace or Solstice?
That becomes the Future Automation Co. This is the remaining collection of businesses. Building automation, the core of industrial automation like process controls, and energy and sustainability solutions.
So bundling those together?
Yeah, but streamlining them first.
Yeah.
They're rolling out a new, simplified reporting structure starting in Q1 2026. It'll have three segments: building automation, process automation and technology, combining parts of IA and ESS, and a redefined industrial automation.
Getting the house in order before the big aerospace split, telling the market what this future automation co will look like.
Exactly. Creating a clear investment story for what's left behind, making it look like a coherent, high-margin automation and energy transition play.
But the final shape of that automation co isn't quite set yet, is it? Because of that strategic review you mentioned earlier, the pruning.
Right. This is happening in parallel. Management is actively looking at strategic alternatives, which usually means selling or spinning off those PSS and WWS businesses, the warehouse automation and productivity solutions stuff.
The ones dragging down the industrial automation margins.
Precisely. Those units did over $2 billion in revenue in 2024, so they're not tiny, but they're the low-margin, lumpy part we talked about.
And getting rid of them would make the remaining automation co look better financially. Higher margins.
Immediately. Management basically said they're a poorer fit. Low barriers to entry, cyclical, margin drag. Selling them cleans up the portfolio, makes Automation Co. look more like a high-tech, recurring revenue business, less like a commoditized hardware seller. It's strategic cleanup.
Okay, so they're subtracting pieces, but they're also adding aggressively, aren't they? This massive M&A spree. How much have they actually spent?
It's pretty staggering. Since late 2023, they've announced deals totaling around $14 billion.
Wow.
Didn't they have like a capital deployment target?
They did. They committed to deploying $25 billion between 2023 and 2025 on M&A, dividends, buybacks. Well, with $14 billion just on M&A already announced, they blew past that total commitment way ahead of schedule. They are hitting the accelerator hard.
Isn't that risky? Trying to spin off aerospace, potentially sell PSS, WWS, and integrate $14 billion worth of new companies all at the same time? That sounds like a recipe for chaos.
That is the absolute core execution risk. It's incredibly complex, like juggling chainsaws while riding a unicycle.
Or as you said, heart surgery and a body transplant simultaneously. Yeah, something like that. But, and this is the bull case argument, every single one of those acquisitions is strategically targeted.
Yeah.
They're not just buying stuff randomly. They're buying assets specifically to strengthen the core businesses of the future separated companies.
Yeah.
They're building the portfolio they want, not just splitting the one they had.
Okay, let's connect the dots. Which deals fit where? You mentioned those megatrends.
Perfect. Look at CAES Systems. That acquisition directly bolsters the future Aerospace Co's capabilities in defense electronics. High growth area.
Makes sense. What about Automation Co.?
For building automation, they bought Carrier's Global Access Solutions business. Think brands like Lenel S2. Strengthens their security and building access offerings, makes BA even stickier.
Okay. And the big ones targeting the energy transition for the ESS part of Automation Co.
Two huge deals there.
Yeah.
They spent $2.2 billion on Sundyne. Sundyne makes highly specialized pumps and compressors crucial for things like green hydrogen production and carbon capture core ESS growth areas.
Right, enabling tech.
And then they paid $1.8 billion, roughly another couple $1 billion, for Johnson Matthey's Catalyst Technologies business. This directly expands ESS's technology library for making renewable fuels, especially sustainable aviation fuel. It's buying leadership in key transition technologies.
So the M&A is very deliberate, aimed at beefing up the post-split entities. And there's new leadership overseeing all this.
Yeah, Vimal Kapoor took over as CEO in mid-2023. It seems like that transition really lit a fire under this whole transformation process, a renewed focus on accelerating growth and being much more aggressive with the portfolio.
And that new reporting framework coming in Q1 26, that's about setting the stage for investors.
Absolutely. It's management saying, look, forget the old four segments. This is the new Automation Co. story. Here are the pieces. Here's how they fit together. They're shaping the narrative well before the final split happens, making it easier for the market to understand and hopefully value correctly.
Okay, so the structure is changing, the portfolio is being reshaped. But long-term, the success of these new companies, Aerospace Co. and Automation Co., depends on their competitive advantages, right? Their moats.
Absolutely. The whole point is to isolate and highlight those moats. Let's start with aerospace again. You called it a fortress moat. Why?
It really is. It boils down to those switching costs and regulatory barriers we talked about. Once Honeywell Avionics, or an APU, is designed into an aircraft platform and certified by the FAA or ES,
it's almost impossible to rip it out and replace it with a competitor's system. The cost, the downtime for the airline, the engineering work, the recertification process, it's just prohibitively expensive and complex.
So it creates this incredibly sticky long-term relationship.
Exactly. It guarantees decades of high-margin aftermarket revenue parts, services, upgrades tied to the number of hours those planes fly. And with flight hours recovering and defense budgets strong, that moat translates directly into predictable, profitable growth. It's almost like an annuity.
Okay, clear moat in aerospace. What about the future Automation Co.? The moats there seem a bit different, more about integration and software.
Yeah, they're different but still strong in key areas. In building automation, the moat comes from those deep, long-standing relationships with building owners and facility managers. They don't just sell a thermostat, they sell integrated systems.
Fire, security, HVAC, lighting control, all talking to each other.
Right. And increasingly, all feeding data into their software platform, Honeywell Forge. That integration creates stickiness. Once a building is running on Honeywell systems in Forge, it's complicated and disruptive to switch everything out.
And that generates recurring revenue.
Yes, from service contracts and, importantly, from the software subscriptions for Forge. That software piece is crucial for the valuation story.
Right. You mentioned Honeywell Connected Enterprise, HCE, which houses Forge. That's a growth driver.
Huge. HCE has been growing sales at something like a 15% compound annual growth rate since 2019. That kind of consistent high-margin software growth helps Automation Co. look less like a stodgy industrial company and more like a tech-enabled solutions provider that supports a higher valuation multiple.
Okay, software and integration in BA. Now, what about the moat in the energy and sustainability solutions part of Automation Co? This seems critical, tied to that huge energy transition trend. UOP is the core here.
Absolutely. The moat in ESS, especially within UOP, is pure intellectual property and decades of technological leadership. UOP doesn't primarily sell big, heavy equipment.
They sell the recipe.
Exactly. They license patented chemical processes, they sell the know-how, and the essential catalysts needed to make those processes work efficiently for refining petrochemicals and now increasingly for decarbonization technologies.
So the barrier to entry is having that unique patented technology.
Precisely. Competitors can't easily replicate these complex chemical processes. It makes UOP a capital-light business. They're selling IP, not factories, but generates very high margins.
And recurring revenue from catalyst sales.
Right. They get licensing fees up front, then ongoing revenue from selling the proprietary catalysts needed to run the license process. It's a beautiful model, highly profitable, and less cyclical than selling just equipment.
And they're applying this model heavily to sustainable aviation fuel, SF. You said they're a leader there.
The leader, arguably. Honeywell UOP has multiple commercialized pathways to produce SF, which is critical for airlines trying to meet net zero goals. They have eco-fining, which uses waste fats and oils.
Okay.
They have the ethanol to jet ETJ process, using ethanol from corn or sugarcane.
Right.
And now the really advanced defining process, which is fascinating. It uses captured carbon dioxide and green hydrogen to create synthetic e-fuels.
Wow. Multiple shots on goal for SAF production.
Exactly. This diverse technology portfolio makes them an indispensable partner for the entire aviation industry's multi-decade decarbonization journey. It's a massive long-term moat based on essential technology.
So when you put it all together, you contrast these really strong defensible moats, the aerospace aftermarket lock-in, the UOP process technology IP with those other businesses.
Like the PSS and WWS warehouse stuff we talked about. The transactional hardware, the competitive bidding, the lower switching costs.
You see why they had to be separated.
It becomes crystal clear. Keeping those lower moat, more cyclical businesses attached was diluting the financial performance and, more importantly, obscuring the value of the crown jewels. The breakup lets the market clearly see and value those fortress moats in aerospace and the technology leadership in ESS without the noise and drag from the other parts. #V, financial performance and navigating headwinds. Now, it's really important to stress this whole massive realignment, this deconstruction. It wasn't launched from a position of weakness. Honeywell was and is performing really well financially.
Yeah, you mentioned they actually raised their long-term growth targets back in 2022 to 4.7% organic growth.
They did. And they've been hitting the high end of that range. Look at Q3 2025 again. Overall organic sales up 6%, adjusted earnings per share up 9%. They beat their own guidance. The momentum was strong going into these big moves.
And the future looked bright, too. What about orders and backlog?
That's a key indicator for industrials. In Q3 25, orders were up a huge 22% year over year. That drove their total backlog to a new record. $39.1 billion.
$39 billion, that's almost a full year's revenue already booked.
Pretty much. And that backlog was up 11% organically. That gives them incredible visibility into future revenue well into 2026. It's like having a guaranteed pipeline of work.
And that confidence allowed them to raise their guidance for the full year 2025.
Exactly. They guided to approximately 6% organic sales growth for the full year, right at the top end of that 4-7% long-term target range, even after factoring in the Solstice spinoff, which slightly reduced the baseline.
Okay, strong top-line momentum, great visibility. What about cash flow? That's the lifeblood.
Honeywell is a cash machine. Consistently generates strong free cash flow, FCF. For 2025, they were guiding for somewhere between $5.2 and $5.6 billion in FCF.
And that's the money they use for, well, everything. Acquisitions, dividends.
Everything.
Yeah.
That predictable, robust cash flow is what funds this entire transformation. And they've showed discipline in how they use it. You see the aggressive M&A that $14 billion deployed.
Right.
But they also consistently return cash to shareholders. They've raised their dividend 15 times since 2010, and they buy back stock. They've reduced their share count by about 15% since 2017, which boosts earnings per share.
Yeah.
So it's a balanced approach.
Okay, sounds pretty rosy. But there have to be challenges, right? Headwinds. You mentioned margin pressure earlier.
Absolutely. That's the big one. Despite the strong demand and record backlog, those persistent cost inflation pressures were definitely biting into profitability. It's the single biggest challenge they were fighting.
We saw the numbers. Industrial automation margin down 150 basis points.
But even aerospace got hit. Yes. Even the powerhouse AT segment saw its margin drop by 160 basis points in Q3 25 compared to the year before. That's a significant decline for their most profitable business.
Why was that happening in aerospace despite the strong demand? Just input costs or something else?
It's a combination. Yes, input cost, inflation materials, labor was a factor, but also think about the costs involved in rapidly ramping up production to meet that huge surge in demand and backlog. That can be inefficient initially.
Hiring, training, maybe supply chain bottlenecks.
All of that. Plus, you have the cost associated with integrating these big, complex acquisitions like CAS and Sundin. Integration always costs money up front before you get the synergies. Those costs hit the P&L immediately, even if the revenue benefits come later. It creates a temporary dilution effect on margins.
So it's this weird tension, fantastic demand driving record sales and backlog, but a tough cost environment squeezing margins.
Exactly. And that brings us back to the execution risk. Management has to navigate that margin pressure, deal with inflation, while executing this incredibly complex corporate separation while integrating multiple billion-dollar companies.
Mhm.
It's a massive operational juggling act.
And you mentioned cyclicality too. Not everything is booming like aerospace.
Right. While aerospace is riding high, parts of the industrial automation segment, especially those tied to shorter cycle factory automation or logistics in places like Europe, we're seeing some slowdown. So they're managing different cycles within the conglomerates, even as they try to break it up. It just adds another layer of complexity.
All right, so we've seen the strong parts, the weaker parts, the strategic moves, the financial performance, the risks. It all leads back to this core idea, unlocking value. Let's quantify that. How big is this conglomerate discount they're trying to eliminate?
Okay, let's look at valuation metrics. A common one is the price-to-earnings ratio, PE. Right now, Honeywell trades around, say, 22.7 times
And
earnings.
historically,
Its own 10-year average PE is closer to 26.7 times. So just based on its own history, it's trading at a discount of roughly 15% right now. The market is clearly nervous about the complexity or the execution.
okay, a discount to its own past. But how does it compare to other companies, especially the pure play ones it wants to emulate?
That's where the gap really shows up. For big industrial companies like this, analysts often prefer using enterprise value to EBITDA. It strips out some noise from financing and depreciation.
Enterprise value is market cap plus debt, basically the total theoretical takeover price. EBITDA is earnings before interest, taxes, depreciation, and amortization, a proxy for operating cash flow.
Exactly. So Honeywell as a whole, this mixed conglomerate, trades at around 17.8 times EBITDA.
17.8x. How does that compare to, say, a pure aerospace company like GE Aerospace after its spinoff?
Big difference. GE Aerospace, a much more focused peer, trades at nearly 29.7 times EBITDA.
Wow, 29.7x versus 17.8x. That's huge.
Big.
Like a 67% higher valuation multiple for the pure play.
It's enormous. And that gap is precisely what Honeywell is trying to capture with the tax-free spinoff of its own aerospace business. They believe their aerospace unit, once standalone, deserves a valuation much closer to GE Aerospace's than the current blended 17.8x it gets stuck with inside Honeywell.
Okay, so this leads us directly to the sum of the parts calculation, the SOTP model. This is the math behind the breakup strategy.
Right. The logic is simple. Value each piece separately, using multiples appropriate for its specific business and peer group, then add them up. Because the market gives higher multiples to high-growth, high-moat businesses like aerospace, the sum should be greater than the current value of the whole.
Walk us through an illustrative example. How would that work for Honeywell?
Okay, let's take the future aerospace co. Given its strength, let's assign it an illustrative EV/EBITDA multiple of, say, 22.0x.
Well, wait, 22x is still way below GE Aerospace is almost 30x, right?
Exactly. It's a conservative assumption. It implies there's still potential upside even beyond this basic SOTP if they execute well. But even at 22.0x, applied to aerospace's estimated EBITDA, that piece alone gets an implied enterprise value of around $121 billion.
Okay, $121 billion for Aerospace Co. using a 22x multiple. What about the remaining Automation Co.?
For the core Automation Co., assuming they successfully divest the lower margin PSS/WWS bits, it's now a higher quality, more focused business. Let's apply a peer-appropriate multiple of, say, 18.0x EBITDA to that. That's slightly above the current blended multiple, reflecting its improved profile.
And the PSS/WWS bits being sold off.
You'd apply a lower divestiture-type multiple to those, maybe around 12.0x, reflecting their lower margins and cyclicality.
Okay, so you've got Aerospace at 22x, the core Automation Co. at 18x, and the stuff being sold at 12x. You add all those implied enterprise values together.
And the total implied enterprise value for the sum of these parts comes out to roughly $212.2 billion in this illustrative model.
$212.2 billion. How does that compare to where Honeywell is valued today?
Significantly higher. Once you adjust that $212.2 billion enterprise value for Honeywell's estimated net debt, around $25 billion, and maybe some other minor assets, it translates into an illustrative implied share price target of around $302 per share.
$302 compared to where it trades today. That's the potential upside management is chasing with this whole complex realignment.
That's the mathematical prize, proving that two focused, well-understood companies are worth considerably more to the market than one complex, harder-to-value conglomerate.
Okay, that makes sense. But there's one more piece we haven't really talked about, a kind of hidden asset, Quantinuum.
Ah, yes, the wild card. This is fascinating. Honeywell owns a significant chunk, a majority stake, actually in Quantinuum.
And Continuum is a quantum computing company.
Exactly, a recognized global leader in the field combining Honeywell's quantum hardware expertise with Cambridge quantum software. It's totally unrelated to the core industrial businesses.
And it's valuable.
Potentially very valuable. There was a funding round for Quantinuum recently that implied a pre-money valuation for the company of $10 billion.
$10 billion. So Honeywell's majority stake could be worth.
Easily over $5 billion on paper. That's a huge slug of potential value, more than 2% of Honeywell's entire market cap sitting in this non-core high-tech venture.
Is the market giving them credit for that $5+ billion right now?
Probably not fully. It gets lost in the noise of the big industrial story. But it represents this significant chunk of, call it, optionality. A
Yeah.
high-risk but potentially very high-reward asset that's just sitting there. Could be a future source of cash or value realization down the road. It's a hidden kicker to the story. Hashtag 7. Conclusion.
Okay, we've covered a lot of ground. This Honeywell story, this great realignment, it's definitely one of the most ambitious transformations happening in the industrial world right now. High stakes, aggressive moves.
Absolutely. So let's try to boil it down for you. What are the two sides of the coin here? The bull case versus the bear case.
Yeah, give us the nutshell version. Why should investors be excited?
Okay, the bull case rests on a few pillars. First, obviously, the value unlock from the separation. The SOTP math we just went through. Forcing the market to value Aerospace Co. like a pure play should close that big valuation gap.
Makes sense. What else?
Second, the remaining Automation Co. will be a better business. Streamlined, higher margin, especially if they sell PSS WWS, squarely focused on those big automation and energy transition trends. It should be a more attractive investment on its own.
And the team running the show.
That's the third point. You have a proven management team under Vimal Kapoor that has a track record of beating expectations and, crucially, executing complex moves quickly. Look how fast they spun off Solstice. They seem capable of handling this complexity.
Okay, that's the optimistic view. Now, paint the picture for the bears. What could go wrong?
The bear case is pretty much all about risk. First and foremost, sheer execution risk. This is incredibly complex. Separating two massive companies, integrating maybe $14 billion in acquisitions, potentially selling other bits. Doing all that simultaneously without dropping the ball is a monumental task.
Delays, cost overruns, integration fumbles.
Exactly. If the execution stumbles, if the timeline slips, if the costs balloon, that SOTP value might not materialize or at least be delayed. That's risk number one.
What else worries the bears?
Second, those persistent margin headwinds.
Hmm.
We saw inflation and integration costs hitting even aerospace. If they can't get those under control, if they can't push price or productivity gains fast enough, then strong revenue growth might not translate to the bottom line as expected. That 160 basis point drop in AT margin is a warning sign.
And the broader economy.
That's the third risk. The company is still vulnerable to a cyclical downturn. If we hit a sharp recession, if air travel unexpectedly stalls again, or if major non-residential construction projects get canceled, that record backlog could shrink fast, potentially before the separation even happens. The timing matters.
Okay, clear bull and bear arguments. So for listeners wanting to follow this saga over the next year or two, what are the key things they should be watching? The milestones.
Number 1, separation timeline updates. Management is targeting the second half of 2026 for the aerospace automation split. Any significant delays reported in earnings calls would be a red flag.
Got it. What else?
Number 2, the outcome of the PSS and WWS strategic review. Will they sell them, spin them, keep them? Getting clarity on that defines the final, potentially more attractive profile of Automation Co. Watch for announcements there.
Makes sense. Financially.
Monitor segment margin trends, especially in aerospace. Can they reverse that 160 basis point contraction? Can industrial automation stabilize or improve its margins? That shows if they're winning the battle against inflation and integration costs.
And the leading indicator.
Keep an eye on order growth and backlog evolution. That $39.1 billion backlog provides confidence. If order growth slows significantly or the backlog starts to shrink, it signals potential trouble ahead for revenue in 2026 and beyond.
Okay, timeline, strategic review, outcome, margins, and backlog. Got it.
It really is a fascinating story. A giant conglomerate deliberately taking itself apart, piece by piece, spending billions to reshape the remaining parts, all in pursuit of that higher valuation, chasing that 302 Arambic car.
It leads to a final, maybe provocative thought for you, our listeners, to chew on. It connects that industrial core with the high-tech wild card.
Go on.
Given this intense, all-consuming focus on executing the separation, integrating $14 billion in industrial M&A, and achieving that pure play valuation, does the leadership team, does Vimal Kapoor really have the bandwidth or maybe even the strategic desire to actively manage and nurture that high-risk, high-reward continuum state?
The quantum computing venture, yeah.
How high could that implied $5+ billion value go if quantum computing takes off even faster than people expect? And what will Honeywell ultimately do with it? Will they eventually monetize it, sell it, spin it off to double down on the core industrial focus and maybe return cash to shareholders? Or will they hold on to potentially the ultimate future-defining technology asset, even if it risks distracting them from the primary mission of perfecting these industrial pure plays?
That's a great question. A real test of strategic focus for a company that's suddenly obsessed with becoming simpler and more focused. What do you do with the ultimate complex, non-core asset?
Something to think about.
That's all for this deep dive. Thanks for joining us.
We'll see you next time.